To break down the short-term rental loophole, summarize it real quick. You have to get an exception to the definition of rental activity. That's 7 days or less, average stay for the entire year.
Mhm.
30 days or less if you provide substantial services. One of those two, right? We check one of those boxes. We're moving on to, did you materially participate? To materially participate, there's 7 tests, but 3 are relevant to most taxpayers. That's going to be you either spend more than 500 hours on the activity, or you do substantially everything yourself, so you're a one-person show, or you spend more than 100 hours and no one else spends more time than you. Once you kind of get to that point, you qualify for the short-term rental loophole, quote unquote. Now, the next step is actually taking advantage of that by using cost segregation and bonus depreciation to accelerate your depreciation expenses and create these massive losses that can offset your earned income, your W-2, your active business income, and significantly reduce your tax bills. That's kind of the short-term rental loophole in a nutshell.
Hi, Adam Gower here, founder of gowercrowd.com and host of the Real Estate Reality Show at youtube.com/gowercrowd. Thank you so much for joining me today. My guest today, and today's episode actually is another one in our series covering the tax benefits and implications of investing in commercial real estate. It's an absolutely eye-opening, fascinating series. And today my guest is Tom Castelli, who is partner at Hall CPA. And Tom is going to talk about the STR, short-term rental loophole, as known. Right, I prefer to call it the STR rule. But anyway, it's known as the STR, short-term rental loophole. That's what you're going to be learning about today. Gower Crowd builds crowdfunding platforms for sponsors who are trying to raise capital from accredited investors. That is our core business. Our clients manage in excess of $35 billion and have raised at least $300 million. I can actually point to those numbers, but in all likelihood, they have raised over $1 billion from accredited investors. We also provide guidance to accredited investors. So if you'd like to know more about what we do and be part of the Gower Crowd family, go to gowercrowd.com and subscribe to our newsletter. It goes out every Wednesday. You will get an email directly from me. You can hit reply. If you've got any questions, put them in that email. All right, today I am very excited to introduce you to Tom Castelli. This is the STR, what is known as the STR loophole. It's an interesting angle, a way of utilizing the tax code. And Tom is extremely knowledgeable about this. Oh, and by the way, if you want to find out more about Tom, get links to his website and to his profile, etc. You'll find that on the podcast page at gowercrowd.com. All right, without further ado, Tom Castelli, partner at Hall CPA. Here he is. Tom, thank you so much for joining me today. I'm so happy to talk to you today. We're going to be doing a deep dive into the STR. And I really don't like this term very much, but I know that it's used a lot, the STR loophole. Well, is it really? I mean, it's not a loophole. It's just part of the code.
Yeah.
But why don't you tell me, what is the... I really don't want to use that term, actually. But what is the STR? What is the STR?
Oh. Yeah. So I'll tell you exactly how it works and why it's even considered that. Okay.
Fine.
So the way it works is this. So way back in 1986, there was the Tax Reform Act of 1986 that was passed, and in that act, there was something called Section 469 of the tax code, also known as the passive activity rules. And what this did is it made all rental activities passive by default. Now, prior to this act, you were able to buy a rental property and use the non-cash expense called depreciation to generate a loss from your rental property and be able to take the losses from that rental and use it to offset your W-2 or your active business income, what have you, really with no questions asked. But that became very controversial. People didn't like it. So that's where Section 469 came in. Now,
people who didn't use it didn't like it.
Yeah, people didn't use
the people who were using it loved it.
Of course. That's how it always works, right? And so what ended up happening is up until about 1994 or so, there was really no good way for real estate investors who were doing this full time to be able to use their losses against their other income. So basically, the real estate lobby, what ended up happening is the real estate professional status was born. Okay. the real estate professional status allows you to do is if you spend more than 750 hours and more than half your total working time in a real property trade or business, it allows you to take your losses from your rental properties and use them to offset your W-2 or active business income.
Ordinary income, right.
Now, the problem with that is you have to spend more than half your total working time in real estate. And that's between the IRS and tax courts. It's been proving nearly impossible to do that if you have a full-time job. So
if you have a real job,
right? If you have a real job, and remember this, the entire, so this is important here. So the IRS, the reason why this was put into place was to stop provide primarily high income earners buying up properties, not really doing much, and taking these losses to offset their income. That's what this was all about, right? Then the real estate professional status was put in place to allow people who worked full time in real estate to use these losses. Now we enter. So what ended up happening was a lot of people started wondering, like, okay, how can we get around these rules? And slowly but surely, people started entering the short-term rental market, and we uncovered that in the regulations, there is an exception to the definition of rental activity. And that exception is if you rent the property for an average period of customer use of 7 days or less, it's no longer a rental activity under the definition of that. So what does that mean? That means it's not passive by default. It also means you do not need to qualify for the real estate professional status to use this.
Yes. In other words, I'm just going to jump in and tell you that I've read absolutely as much as possible as I can of all the stuff you've written, including your emails, a bunch of stuff you've published, very, very detailed. This is a very interesting nuance that you've got here. And I love the language that you use here because it helped me to understand what was going on here. Basically, I'm just going to try and rephrase it.
Yeah.
Basically, what you are saying is that by having these rental losses or this rental activity is part of your active work. It's part of it. Any income you generate is ordinary income.
Yeah.
Correct. And therefore, any losses can be offset against ordinary income, but not just ordinary income from the rental itself, but from your day job.
Right. Using the short-term rental loophole.
Yes, using the short-term rental rule. That's exactly the point. It converts it basically says that the income is not passive. In other words, you got to work for it. Exactly. And therefore it goes into the bucket of ordinary income. It's all in that same bucket.
Yeah, exactly. Now, just briefly before we move on, I just want to say, why is this called a loophole, right? It's in the regulations. It's in IRS publications. Multiple tax court cases confirm that this is indeed real. Well, the reason why people consider it a loophole is because the reason Section 469 was put into place was to prevent people from doing this, right? From say me or you going out, or whoever, say I don't work full time in real estate, right? It was for prevent someone to go out and buying a rental property and using the losses. But now with Airbnb, I can go out, buy a rental property, put it on Airbnb for 7 days or less, and now I meet this exception. So
average of 7 days.
Average 7 days or less, exactly. So basically, by doing this, the intent of Congress was to block people from taking your typical property and using the losses. But now we're getting around those rules thanks to Airbnb, and that's not exactly how Congress, when these rules were written in the 80s and 90s, intended this to work.
Yeah, it's an unintended consequence. But hang on a second. Here's where I've got to jump. This is where I stumbled when I was talking to Brandon. So anyone listen to this, you've got to listen to the conversation I have with Brandon Hall as well. You'll hear me tripping up all the time, right? When he starts talking about the STR, you'll hear me tripping up because I didn't really understand it, but now I do, I'm glad to say. Here's the issue though. And I think there's a lot of misunderstanding with this. At least there was with me. And so I'm assuming other people have the same misunderstanding.
Yeah.
It is often said that the real estate professional status, if you can't get that, and it sounds like it's almost like, how do I qualify to be an accredited investor? You either are or you're not. It's like basically it. Yeah. You either are or you're not. And it's the same with real estate professional status. You are either a real estate professional or you are not. I mean, that's all there is to it. And you can define it, you can explain it, but the reality is you either work in real estate or you don't. At the end of the day, that's what it means. But What people talk about a lot, this is where the confusion I think is that the STR, the short-term rental loophole, is often discussed in the same sentence as real estate professional status. And that's the idea, that it's a loophole, but it doesn't exactly work the same way, does it, Tom?
No, it doesn't.
Yes. It only works on the property you purchased. Right. Whereas real estate professional status allows you to uniformly or universally use losses against active income, ordinary income, passive losses against ordinary income. The STR rule only allows you to do it against the property that you're talking about.
Right. The real estate professional status is for rental activities, which fall under that definition with like long-term rentals. But then with the short-term rental loophole, we're only talking about properties that have an average customer use of 7 days or less. And that's the only thing that qualifies. It's the only thing that it's used for is in that instance.
But it's not just that. It's if I buy, so this is where I got, but when people say instead of real estate professional status, you use STR rule. It's not the same. If I go out and buy a house and rent it, and I rent it for average periods of less than 7 days throughout the year, and I spend, I mean, there's various criteria. Please explain those to us in a minute. But I spend a certain amount of time on it and write the rules and regs about that. If there's any losses like accelerated depreciation, for example, on that property, I can take those losses against ordinary income. But it doesn't mean that if I've invested in a syndication over here, that I can use that passive income. I can offset against that passive income or use that passive income either. It doesn't throw the switch on my entire tax world like real estate professional status does. It only does it on the properties I own, right?
Yeah, correct. 100%. It only works for short-term rentals. Now, when you're looking at the real estate professional status and limited partnership interest is a little bit different. The rules are a little bit different there. So to you, if you go and invest as a limited partner into a syndicated fund, you are in that bucket of being passive by default. One, by the virtue of it being a rental activity. The other, by definition, under the code, the tax code, if you are a limited partner, you are not actively involved. So if you go and invest in that syndicated fund, you cannot take those losses against your active, W-2 or business income. Now, the only way to really get around that is to qualify as a real estate professional, which again, 750 hours and more than half your total working time in real estate. And within that, you have to spend 500 hours actively managing properties that you own. And then when you do that, you're going to make a grouping election to treat all of your rental activities as one activity. And then you're grouping in your LP interests with the rest of your rental activities that you're actively managing. And then at that point, the losses can be used to offset your.
The whole thing is universal, right?
Right.
Exactly. And you've got to keep pretty good records of all that. You've got to be very well prepared if you're audited.
Right. One of the key, if you're going to go for the real estate professional status, you need a time log. And there's been.
You need a what?
A time log of some sort.
Yeah.
Right. Like there's hundreds of tax court cases on this. And out of all the tax court cases, the taxpayers that often win these audits have really good records. So they have a time log saying, here's all the hours I spent. I spent more than 750 and more than half my total working time. So you need to keep those records if you're going to be using this.
Right. And it's the same with the STR loophole, isn't it?
Right.
I'm not going to use that term. STR rule.
Okay.
You can use it. Feel free. I don't like it. But the STR rule, what are the rules?
Yeah.
STR rule. Yeah.
So there's kind of the STR rules. There's kind of two different parts to it. All right. So the first part is meeting the exception to the definition of rental activity. So there's a few different exceptions out there. I mentioned one of them, the 7 days or less average period.
That's average during the year.
Yeah. Average for the entire year. You add up all your stays, divide it by the amount of days, and you're going to have your average period of customer use. That's one of the exceptions. Another exception that's relevant to short-term rental owners is that if it's average period of customer use, so average of 30 days or less for the year, and you're providing substantial services. And substantial services are services that you might find in a hotel, like daily cleaning, daily meals, daily breakfast, things of that nature. If you meet that exception, you're also meeting the exception. Now, there's a few other ones basically intended more for hospitals, like where you're providing extraordinary services, but we're not going to go down that rabbit hole today. But So say you meet one of these exceptions we just mentioned. Now you're in the short-term rental bucket. Now, it could still be passive or non-passive. To make it non-passive, you have to meet there's 7 material participation tests, but there's really 3 that are relevant to most investors. And that's going to be you spend more than 500 hours on the property. Or you do substantially everything yourself. So you're basically a one-person show. You have very little to no outside help. Or the third one is you spend more than 100 hours and no one else spends more time than you. And this third one here, where you spend more than 100 hours and no one else spends more time than you, this is probably the most popular one because it allows you to still like head up the property and make sure everything goes like you're running point, but you can hire cleaners, you can hire handymen and run it from a distance. So that in a nutshell, those are the 2 requirements, right? You have to meet the exception, then you have to materially participate by meeting one of those tests. And that's how the short-term rental loophole works.
What kind of activities, Tom, count as being towards that 100 hours?
Yeah, so that's a great question. So believe it or not every hour you may think counts towards these tests. So typically it's going to be time spent in the day-to-day operations of the activity. Like the IRS, the rules, the way they're written, they want to see that you're actually managing these properties and you're not just handing it off to a property manager. So time that would count are things that a property manager would typically do for you. That includes managing listings, guest communication, for short-term rentals specifically. It's going to be managing handymen, cleaners coming and going, fixing the property, repairing it yourself, handling customer complaints. Perhaps when you first buy the property, maybe you have to get it ready, right and ready. So you have to go in there, you have to furnish it, you have to get it, you have to perform some maintenance and whatnot. Those types of hours will count towards the short-term rental loophole.
Right. Yeah, and importantly, you've got to do more than anyone else. So if you've got a plumber in there that spends 200 hours fixing something,
right, you might be.
Said the former electrician, pointing his finger at the plumber. But you've got to spend 200 hours, correct?
Right.
Yeah.
Well, you have to spend 201 hours, right? Because they spend 200 hours.
Right.
You have to spend more time than then. Yeah.
Yeah, not just equal. All right, Tom. So here is the $64,000 question. You are far too young to know what that actually means. And I'm English, but I know what it means. It was a game show, I think, in America 100 years ago. The $64,000 question is that the real only benefit of the STR rule is depreciation. That's really the only benefit, because there's little point buying a short-term rental and running it at a loss, right? Yeah. Right. So just explain when you unwrap this thing all the way down, where is the actual benefit? How does that work? And also, if you would please actually get to the next thing. Let's start there. Where actually is the benefit? In fact, if you've got a case study or something, give us an example of that.
I could give you some. I could break it down and give an example right after that. So basically, at the end of the day, when people first learning about this, hearing about this for the first time, they're like, well, why would I want to generate a loss for my rental property to begin with, right? Don't I want to make money? Isn't that the reason why I'm in this business to begin with? Well, many would hope that's the reason, right? But here's the way it works. So when you buy a rental property, whether it be a short-term rental or a long-term rental, what's going to end up happening is you're going to depreciate it over many years. So let me give an example. Let's just say you purchase a $500,000 rental property, right? So land is never depreciated. So we always have to allocate a portion to land. So let's just say that 80% is allocated to the building. So that's $400,000. Now, this $400,000, if you were to use straight line depreciation with short-term rentals, it's usually about 39 years because it's considered commercial, because it's short, only being rented for a very short period of time. So that's typically, that would give you on this $400,000 property an annual depreciation expense of roughly $10,250.
Right.
It's nice, but it's not tremendous. Now we have something called cost segregation studies and bonus depreciation. So when you buy this building, you're not just buying the building, you're buying the house, you're buying the appliances, you're buying the flooring, you're buying all these different components. So what a cost segregation study does is there's usually an engineer that comes to your property, although there's software that could do it these days, and they will survey your property and give you a report saying, here's all the components in your property and here's what they're worth. right? Now, then we have bonus depreciation. So bonus depreciation allows you to rapidly accelerate the depreciation of certain components of property. Specifically with real estate, it's going to be 5, 7, or 15-year property.
Right. So just to jump in there, I mean, we have talked about this in some detail on another show, but what you're referring to is that there are certain things inside any kind of building that the IRS allows to depreciate at different rates, not 39 years. Some are what are they? 7, 15?
It's 5, 7, and 15.
5, 7, and 15. All right. But accelerated depreciation was a new law that does what exactly with those 7 and 15.
Yeah, right. So what this does is it allows you to rapidly accelerate. So I'll give you an example is the best way to look at it. So this $400,000 property, usually a cost segregation study will say somewhere between 20 and 30% of that building will be reallocated to these lower class lives. So we're going to take 25, we'll split it right down the middle, 25%. We're looking at $100,000, right? So now this is $100,000 that's eligible for this depreciation. Now, right now, bonus depreciation, as of this recording in 2024 is 60%. So that means you're able to take 60% of this $100,000 and deduct it all in 1 year. So we go and take 60% of 100,000, that's $60,000. So now what's going to end up happening is on your profit and loss statement, you're going to have rental income. You're going to have, and on a $500,000 property, let's just say it's like 20 grand, just to keep it simple. Then you have your expenses. These are going to be expenses that leave your pocket. You have to go pay taxes and property managers or whoever. Now you're going to have this one big, massive expense on your P&L called depreciation, which is going to be $60,000. Now, the best thing about this expense is it's non-cash. It only exists on paper. So you're not really losing money. So let's just give this example, right? So say you had $10,000, $20,000 in rental income. All right. Now let's say you had, let's just call it $15,000 in actual expenses that you had to take to operate the property. I'm just pulling numbers out of the hat. Now you have the $60,000 depreciation expense. Well, now you have a loss of $55,000.
5,000. All right. 5,000. I thought we got to 5,000. Oh, I see. Yes. $55,000 loss. Right.
And now just the kind of, if you were at the 37% tax bracket, let's just say this $55,000 loss, quote unquote, because it's only on paper, is worth $20,350 in tax savings.
So I'm gonna say that again in 5-year-old language. So basically, what you're saying is that so I've got this rental property. Let's say I make 5,000 a year of profit. I've got this paper loss of 60,000, and I'm an accredited investor, so I make 200 grand a year working a day job, ordinary income, unrelated to real estate. So I got this $5,000 profit that comes off the property. So now I've got 205,000 of income, one way or another. But that 60,000 can come off that. So now I'm down to 200. What is it? 55,000, 245,000. Sorry, 145,000 would be the amount of income that I would be showing that would be taxed.
Right. You're significantly reducing your taxable income.
But we can only do that in year one, can't we? So that's then we get a little bit of depreciation now over 39 years of whatever is left.
Right. And it's not gonna be nearly as much. So yeah, this is very much a first year strategy, which, you know, not to get too far ahead of ourselves here, which is why just like when we're talking to clients about this, we're always like, look, if you want to enter the short-term rental business and be in the short-term rental business and operate it like a real business, and by all means, it's a great opportunity for you. But if you're just using it for the tax benefits, you might be disappointed after the first year. You find out
well, there's more to it than that, isn't there? But let's just add another layer. Let's say you want to do this big time and you go out and buy 10 $500,000 properties, but your income isn't big enough. Your ordinary income isn't big enough in year one to accommodate all the depreciation. Right. You can carry that depreciation forwards. You don't lose it. It just carries forwards to the next year until you've finally depleted it. Correct?
Yeah. Right. So yeah. So that so the way it works is if you have so much losses, so your losses are so high that it completely wipes out your taxable income plus some,
Hmm.
then those losses get suspended and carried forward to future years where they can then be used
Against
against you.
ordinary income.
Yeah,
Right.
in the future.
Okay. Now, very important. This is also super important. You have to take depreciation, comma,
Right.
don't you? Question mark.
Yeah. Yeah.
And
So
why?
yeah. So here's the thing, right? So depreciation is mandated under the tax code. You have to take it. There's no getting around it. Now, some people just forget to take depreciation or don't know they have to take it, so they don't take it. But other times people think they don't have to. People don't take it because they're scared of something called depreciation recapture.
Yes, I was
And
going to come to that.
yeah, so the way that this works and the way that depreciation recapture works is let's use an example. The best way to describe this is always with an example. Let's go back to our $500,000 property, right? So let's say so when you buy a property, you're gonna have $500,000 plus some of your closing costs are gonna equal your cost basis, which is known as your unadjusted basis. So let's just say it's $500,000, keep things simple. Now, whenever you take depreciation, it's going to be deducted against your cost, your unadjusted basis to give you your adjusted basis. So in our example here, let's just say after the first year, your adjusted basis would be $440,000 because remember you had $500,000. Now you took $60,000 of depreciation. Now you have a cost basis of $440,000. Now, if you were to go and sell this property today, let's just say it appreciated to $600,000. Well, now you're going to have a gain of
Well,
your
why don't we say that you flip it and you sell it for 500? I mean, that's the easiest thing to think
uh,
about. You would think that would be a wash, wouldn't you?
right. Yeah, yeah. You would think that
I
if you
bought it for 500,000, I sold it, no gain.
right.
But that's not quite how it works, is it?
Yeah, yeah. So it's not quite how it works because when you sell it for $500,000, your gain is not based on your sales price minus your unadjusted basis, aka the amount you purchased it for, but rather your adjusted basis. So now in this example, you would have a gain of $60,000 that you'd have to pay taxes on, and
Right.
this gain is considered depreciation recapture. So depreciation recapture is a tax on the amount of depreciation that you've taken over the course of your ownership. And that's sometimes the reason why some people think they could avoid recapture by not taking depreciation. But that's not really how it works. The IRS will compute that for you and assume you took it,
And
even if
we'll
you
bill
did.
you.
And they say, hey, thanks for not taking your depreciation, but you're going to
But
get,
here's a bill anyway.
yeah.
Can you retroactively go and take that depreciation if that happens? I
Yeah.
mean, it's a pain, right? You just have to file an adjusted return or something.
Yes. In some cases, you might be able to,
Will you get a
depend.
penalty though? You get penalized. So there's penalties if you don't do it. If you don't take depreciation and then get nobbled with, like, why? In other words, sometimes I do think there's a bit of a game that if there's no penalties, then it doesn't really matter because if you get dinged, which you will get dinged, all
Yeah.
right, fine. But I've had that money anyway, so I can earn a bit of interest on it until then I'll pay it. It's
Yeah.
painful when you end up paying it, but
Yeah, I mean, there's no particular penalty per se for not taking depreciation outside of having to pay the recapture tax anyway, perhaps.
right.
But you can go back and correct it depending on the circumstances. You might be able to amend your returns and just go back and fix it. In other situations, you have to file what's called a Form 3115, a 3115, and that can actually bring the depreciation that you should have taken throughout the years into the current year, and that can help you fix the situation. But it's kind of costly from a compliance perspective to do. So ideally, you're not using that when you don't have to. You're claiming your depreciation up front. But if in the worst case scenario, if you haven't claimed your depreciation, this might be an avenue you want to explore to claim it like
Retroactive.
you can. Right,
Yeah,
exactly.
going back. Yeah. Well, yeah, look, I mean, the best bet is to stay accurate, be precise with your returns. That's why we have guys like you to work with in this world who know this stuff. Depreciation, it is mandatory. Is accelerated depreciation mandatory?
No, it's
Just straight line, right?
a straight line. You can typically depreciate your property over a straight line basis if you so choose to do that.
Hmm.
And some people
So,
choose
so
to do
there's no depreciation recapture on if you failed to do a cost seg study, for example.
Yeah. There's depreciation recapture on that straight line depreciation. But that's fine. Now what happens is with the accelerated depreciation, you're basically just creating a lot more depreciation recapture because you're depreciating a property that much more quickly, which depending on your situation may or may not benefit you.
Yeah, it's an interesting thing, isn't it? So, but let me. Have I missed anything that you would like to comment on with the STR? I'm trying to cover every angle and also angles that people haven't thought about.
Yeah, no. So I think we covered everything, right? To break down the short-term rental loophole, summarize it real quick. You have to get an exception to the definition of rental activity. That's 7 days or less, average stay for the entire year. 30 days or less if you provide substantial services. One of those two, right? We check one of those boxes. We're moving on to, did you materially participate? To materially participate, there's 7 tests, but 3 are relevant to most taxpayers. That's going to be you either spend more than 500 hours on the activity, or you do substantially everything yourself, so you're a one-person show, or you spend more than 100 hours and no one else spends more time than you. Once you kind of get to that point, you qualify for the short-term rental loophole, quote unquote. Now, the next step is actually taking advantage of that by using cost segregation and bonus depreciation to accelerate your depreciation expenses and create these massive losses that can offset your earned income, your W-2, your active business income, and significantly reduce your tax bills. That's kind of the short-term rental loophole in a nutshell. And then you have depreciation recapture, which we just discussed, but that can actually be mitigated if you're in the real estate game for the long haul with 1031 exchanges and other strategies. You mitigate those taxes.
I was just going to ask you. So if we've defined this as non-passive, non-rental, this building, this house that I bought, can I 1031 it? Isn't that a contradiction in terms?
So you can 1031 exchange
because it's not a rental; it's an ordinary income. It's like that's what we just decided, right?
Yeah. So this is
the 1031. Yeah, requires that it's like for like and has to be a rental property, doesn't it?
Well, it's still real property. So for 1031 exchange, you can only exchange real property for real property. And because it's real property used for business or investment purposes, you could still 1031 exchange a short-term rental.
You can. And could I 1031 that into, so there's a big discussion. We're going to have, I'm sorry, I don't want to go off target here. We're talking about STR. But can I 1031 that into a syndication, for example, via a TIC? Like a big multifamily, definitely a rental property.
Like a TIC, yeah. So with 1031 exchanges, you can exchange real property for real property. You could exchange a short-term rental for a
multifamily or an office or something else. I can do
property. Okay. Yeah, single family, self-storage, whatever.
So I can continue to do that. If I did a 1031 of an STR, short-term rental property, and bought something else. Okay, sorry. I mean, tell me if we're out of time. I'm not, but I've got this. This is a key question here, actually.
Yeah.
I just learned this, but I take this. So I've got this this 500. By the way, using a $500,000 purchase. When you're talking to of a short-term rental, when you're talking to somebody living in California, makes my eyes water. I will tell you that because that's the down payment on a house here in California. But anyway, so you buy a $500,000 house, you sell it for argument's sake for $1 million, and you do a 1031. That new property is also going to give you depreciation, but you carry over the depreciation on whatever's left from the first property, don't you? It's not like you get the full benefit. Just high level, how does that work? Because that can be easily misunderstood as well.
Yeah, so this is referred to as basis erosion. So what happens is when you do a 1031 exchange, long story short, really oversimplifying this, but you're basically, when you 1031 exchange into the new property, your cost basis, your unadjusted cost basis isn't the cost basis of that property. So right, say you bought $1 million, say you
the new one.
Yeah, right. The new one. Say it was $1 million. You bought a new property for $1 million. Your cost basis isn't $1 million in that new property when you do a 1031 exchange. Your cost basis is much closer to your adjusted basis in the new in the
old property,
right, which decreases the amount of depreciation that you can take on. It doesn't decrease, but there's less depreciation you can take because the cost basis isn't so high. So that's called basis erosion, and It could be that just basically it's just something to be aware of when you're using this.
Right. Okay, last question on this. Who is the best candidate? Like, who is the ideal, client, I would say? Somebody comes in and they're discussing what they want to do with their, financial world, and, you're doing some planning. I know you have some great planning programs over there at Hall CPA. But somebody comes in, what would be the avatar that you would say, look, this is something that might work for you?
Yeah, so I'd probably say there's probably one or two avatars. The primary avatar I'd say is a high income earning individual or perhaps couple, and they want to get into real estate on a part-time basis, but maybe can't enter it on a full-time basis, right? So they say, hey, we want to invest in real estate. We love the tax benefits. We're willing to put in part-time effort, but we can't go full-time to get the real estate professional. So this would be an ideal situation for that couple, right? They have the money for a down payment. They could go buy a prop or short-term rental. They have the time to actually operate the short-term rental. Mm-hmm. That would be the ideal candidate. On the flip side, it's the ideal candidate, someone who's already in the short-term rental business. They're just buying short-term rentals and they want to learn how to maximize their tax benefits. So there's really two different candidates coming from two different angles. I would say the short-term rental investor and the high-income taxpayer who wants to utilize real estate tax benefits.
All right. Anybody that looks at their watch while I'm talking to them, it's time to wrap up.
Oh, no, sorry.
This is a video. So I used to work with a guy in Japan. He would do this. Okay, you say, yes, when you're in a board meeting. Oh.
I know, it's all the notifications these days. I get notified from like 6 different.
Is that what it is? The distraction, the world of distractions that we have. Tom Castelli, what an enormous pleasure meeting you. It's such a pleasure to meet pros in this industry, in the tax industry. I was clearly mistaken. I thought there was perfect knowledge, that every CPA knew everything.
Oh, yeah.
And I've discovered recently that there are very, very important specializations. You have one of the best for a real estate investor. I really appreciate your time. Tom Castelli, partner at Hall CPA. Thanks for joining me today.
Thanks for having me. It was an honor to be here.
All right, that was Tom Castelli, partner at Hall CPA, talking about the STR rule/loophole. Fascinating, right? The devil is in the details with these things, as you can tell. And in my humble opinion, IMHO, you, especially with tax, you absolutely need to be working with a consummate professional, somebody who knows what they're doing. As far as I'm concerned, it is like brain surgery. You don't want to be doing that on your own head. You don't want to be messing with your own taxes. Work with a professional. Right. So, Tom, thanks for joining me. A fascinating discussion. I really appreciate your spending the time explaining the STR rule to me. And thank you too, dear viewers. A real pleasure seeing you today. It's a real pleasure being able to spend some time with you today, or you spending time, whatever. I've lost the grammatical structure of what I'm trying to say there. If you want to know more about Tom, and if you want to find out more about what Gower Crowd does, go to gowercrowd.com, sign up, subscribe there to our newsletter. You get emails once a week, and you can always unsubscribe. And you will also find more information on the podcast page for today's episode with Tom Castelli. You can find out more about him, his company, and how to contact him. All right, that's it. Thank you for joining me today, everybody. And I look forward to seeing you next time. And for now, this is Adam Gower signing off.